Ladies and gentlemen, former, present, immediate past presidents in the room, I welcome you all to this session. Thank you so much for the invitation, to Basil, for Despina, to sorting everything out. I have 15 minutes, and I'm very eager to share those insights that we have for you coming from the BIMCO market analysis team. My name is Peter Sand, and running the market analysis team at the world's largest shipping association. It's a pleasure to put some focus on the trade war, put some focus on how we see the fundamentals that are the key issue of this first session in the morning, because in fundamentals we trust. And let me say to you that the things that I'm about to share with you are based on the fundamentals that we see. We do not try to put them in a nicer way or a bad way. We try to see things and communicate them as we see them. We believe that will make the decisions amongst our members and the shipping industry in general better, because they do not get a biased view. So please, still, believe at your own risk. This is the BIMCO view on the three main commercial markets: dry bulk, tankers, and containers. We provide tons of information to our members and help them on a daily basis. See me or our current president about a membership or anything else during the day. We hear so many times that shipping is a cyclical industry. I'm here to put a little bit of emphasis on the demand situation, which is not really cyclical. The business is cyclical due to you people. It's the human element that makes it cyclical. The real cyclical thing of the shipping industry is the fleet growth, going up, going down, boom, bust, over again. The only, say, real solid support of the shipping industry is actually the demand side, if you look at it. But of course, it's not all to embrace in the demand situation, because as we try to highlight here, global shipping is certainly scouting for future growth. I think it's known to everyone that the IMF once again revised their estimates for future growth downwards earlier this week. Mostly here in Europe, actually, but also in, well, the world's powerhouse, at least in terms of supporting shipping, China. I'll put a bit of emphasis into that. But I think the real challenge here is to continuously handle the overcapacity of the industry with care, and then manage all the regulation that is all coming in. I'll share just a few views on the 2020 Sulfur Cup as I approach my end. But of course, the ballast water treatment system is also something that is really putting stress on already stretched balance sheets of the industry. Because as it has been pointed out also from the stage by the BIMCO president, the shipping industry has not really been that profitable over the past couple of years. So it's not like we have a massive buffer to all of a sudden invest in a scrubber or ballast water system, or basically just weed out the next downturn. Adjustments have already been made to this one, but the directions remain the same. Rest assured that there are no such thing as just flat lines going forward. There will be volatility, but rest assured also that there will be positive growth. We just need to know where to look for it and how to take advantage of those opportunities. If you look at, especially in the the gray line on top, that's of course very relevant to the dry bulk shipping industry, because this is the emerging and developing markets where they need all the raw materials that are serviced and shipped by the dry bulk shipping industry. Of course, the blue line is a little bit more critical, because that is closely related to container shipping, of course. This is the advanced economies, those who really set up the Chinese manufacturing miracle. That's the demand creation in container shipping that is basically illustrated by a downward trend that just got a tiny bit more sour the other day. So rest assured, we need to handle this current overcapacity, which is the fleet, but we certainly also need to be aware of the, say, the weakening fundamentals of the demand, which are still supportive, but a far cry from what we saw a decade ago. I'm not saying this is the new normal anymore, because this is simply the normal going forward, and with a bit more downside risks than upside risks. Some of the factors have been quite clear to us for some time, so this downward revision came as no surprise at all. If you look at Europe, which is certainly also illustrated on the right-hand side here, indicated by the machinery equipment and technology equipment PMI from HS8 Market, look at the downward trend. It's not a nice one. This is an indication of an industry stalling. And of course, when the shipping part of machinery and equipment and technology is stalling, so is a demand created by those industries. On your left-hand side here, of course, it's relevant to look at, well, in shipping industry, we are a service industry, but we do ship goods. So new export orders, that's a pretty good indication of where the shipping demand is about to be in the coming 3 to 6 months. And if you look at the light green line, it's going in the wrong way, right? If we go back to 2016, I think most of us in here remember 2016 as a very bad year. More or less across the board. It was the worst ever for dry bulk, at least. Container shipping was also struggling. Oil tankers were actually doing very well on the back of the drop in the oil price, making 2015, I think, the best year for oil tankers in more or less a decade, at least since the great crisis of 2008, 2009. So have those in the back of your mind when you look forward into your crystal ball, because it may not be that cloudy. We talk about the trade war because everything is also surrounding by the trade war. Because the trade war is the materialization of what is putting up more barriers to trade rather than liberating the world. I think we all in here can agree that the shipping industry is feeding on globalization, and a trade war is everything but that. But a trade war is, well, 2 words. But what does it really look like? Well, on the left-hand side, you can see the lack of US soybean exports, because the Chinese really put their foot where their mouth is, and they completely ceased taking beans from the American. They got whatever they could out of Brazil, and that was a lot. And then in the final 2 months, well, there wasn't more beans in Brazil. But rest assured, in no more than a month from now, Brazil will once again get into the market with new soybeans. But that is really hurtful, because every single silo and stock is full in the US. Europe have taken some. Animal feed has been short in Europe, so cannot really see it as a geopolitical help from Europe, but we simply needed that soybean and that corn. On your right-hand side, another clear example of what does a trade war look like. Rumors has it now that 3 VLs are on their way to at least Singapore, according to my information, but they are rumored to be carrying US crude oil into China. Let's see if they really get all the way, because that is an illustration of, again, how bad things can be. Chinese completely stopped importing US crude oil in August last year, and they have not taken anything since. Critical in the terms of shipping industry, even though we have seen higher and higher exports of US crude oil, it has only gone to middle part of America, it's gone to South America, some of it have gone to Europe. Volumes are great, but we need the long distances, right? Not just in tankers, not just in, well, containers. This is the trade war put down in numbers. I'll just leave those for you to dwell into when you put your head on your pillow tonight, if you want to get just a little bit of more bad dreams. Because this is very illustrative of what has been implemented. Everything of this is implemented now. This slide includes what was put in terms of tariffs up front, and then a little bit later. But all of this is included now. So it's very easy to see that from the Chinese side, it's all about dry bulk. But we have certainly also seen crude oil and LNG in leading roles, because LNG, the Chinese have also stopped importing LNG from the US. If we move on to the US seaborne imports from nations, again, affected by US tariffs, that's because this is not just a matter of US and China. This is, of course, also US and EU. They're really starting a multilateral trade war over there. But you see, the containerized goods are much more to the forefront. But fortunately for the container shipping industry, that has actually been very positive. Not only due to the fact that 12,000 parking meters or some 127 million lighting sets for Christmas tree has been affected. That's just what's in those boxes. But from the shipping industry, of course, this is the loaded imports that matters. Whereas dry bulk have been mostly hurt, the container shipping industry have been better off, at least when you look in hindsight. If you look what lies ahead of us in the coming year, perhaps also a bit more. Of course, that could snap back in terms of front-loading of goods going into North America in particular. Right. Putting focus now exclusively on the dry bulk, and as I said, the fundamentals and the cyclicality rests, in all honesty, on the fleet. We have seen positive demand growth for dry bulk shipping in every year since the crisis, but for 2016, where it was more or less a zero. But if we look at the fleet growth that we saw in 2018, it's about to be duplicated in 2019. If we bear that in mind and compare that, or set that into the scene of a trade war that may be going even more in the wrong direction, bear in mind that it is only a ceasefire that we see right now between China and US. And just, was it on Tuesday, the Americans called off that extra planned meeting for more senior people to ease those tensions between the two nations. So as Mr. Papagiannopoulos explained earlier, in BIMCO we expect or hope that the trade war will see some kind of, say, easing as the year progresses. A fully resolving of the issue is highly unlikely once things have gone so bad. 2020 is not only about the sulfur cap, but if you look at the dry bulk shipping industry, well, I call it scary here. In dry bulk shipping, it's a lot about China, if it's not all about China. It's absolutely not about Europe, because Europe imported the record into to Europe in terms of dry bulk commodities was back in 2006. Now we sit some 15% lower than that, so forget about Europe in that sense. Focus only on China, and focus on at least some of the, well, you can interpret this the way you want to. As I said, I lay out our baseline, but I want you to understand the dynamics behind that baseline, because a baseline, of course, is a suggestion of, well, this is to our best knowledge where we expect the market to be. But of course, there are upside and downside triggers. In 2019, we expect that trend you see on your left-hand side here to continue, because iron ore into China seems to be past peak now. And it's not just because, well, everything doesn't go into the moon. It's the fact that the Chinese used to be in love with newly produced steel from high-quality imported iron ore. But over the past almost 2 years now, they found out this brilliant new thing called an electric arc furnace. It makes scrap steel into new steel. From a sustainable point of view, I guess that's brilliant. From a shipping point of view, it creates a problem. Because if you have minus 1% in terms of iron ore imports, the main driver of the past 2 decades in the dry bulk shipping industry, of course, that's critical. Then we have the swing factor on your right-hand side here, which is, of course, the coal. China remains and still is the biggest coal producer and consumer of them all, but it's very much not the geopolitics on a global scale, but politics on a very local scale. We saw that at the end of last year already, that Chinese ceased to import coal at a very large extent. So going forward, that will be the swing factor that can bring better markets around, but it can also bring more sour markets around. We're sharing our views here in Athens today, but please subscribe to the BIMCO YouTube channel as well and check out BIMCO.org for more good stuff. Crude oil. On your left-hand side, our expectations are right now for 3% fleet growth in the crude oil. If we look back historically, that has not been good for increased trade rates. So going forward, that is our caveat to the baseline, that we are looking at fundamentals in terms of increased oil demand, but in terms of the fleet growth that we see in 3% in 2019 and also sitting between 2 and 3% in 2020, that is the overcapacity that I'm talking about that we need to handle. If you look at 2018, historically low, almost, low fleet growth, but then again, I think it was highlighted, it was more or less the worst year ever in terms of freight rates. So the overcapacity was actually handled, but the demand situation was such that. On your right-hand side, I think that's the best call that we have for improved markets in 2019, the oil product tankers. And it's predominantly due to the control of the fleet growth. We expect a manageable fleet growth around 3% for 2019. These are the fundamentals, and as I highlighted up front, it is a matter of serving the entire globe. It is a matter of knowing where the demand is generated, who delivers what, and where does it come from. Because when China still imports a record high number volumes in terms of oil, it makes all the difference, whether they take that out of US Gulf, or they take it out of Angola, or the Arabian Gulf. It's only half as much fun for the shipping industry to take it from the Middle East. It's somewhere in between from Angola, but we get all the fun and the long distances because it takes 1.5 months to transport 2 million barrels of oil half the way around the globe. Finally, wrapping up with the container, and we say, on paper, fleet growth looks good. Bringing it all back to a conclusion, Europe represents the key trade lane of container shipping. The Far East to Europe is the long haul, the high volume trade lane that more or less the entire container shipping industry is betting on for high growth. They may not necessarily like it, but that's the case. We see the ultra-large container ship being fed into that trade route. It's critical that we see volume growth on that trade route in order not to pass on the pain by what we call cascading onto to secondary and third lines and trades across the globe. So watch out very carefully that we may forecast on our base lane 3% with an unchanged level of idle fleet. But rest assured that right now I think we have some 600,000 TEUs lying idle. If all those ships in capacity are reactivated, we will have supply exceeding demand. And from a fundamental interpretation, that is a bad thing, at least for freight rates. Customers may like it, but it's a bad thing for freight rates. And I think that basically leads me also to the final wrapping up, because if we are just going into 2020, I think that is the one thing that we need to be focused on. 2020, how to basically handle that from a shipping perspective is a strictly commercial decision. But it also requires you, as financiers, as investors, owners, players of the industry, to understand that you should strip away religion, superstitious thoughts, what once was, and focus on what is actually on your table, just in front of you. From a shipping perspective, what we say is that it very much depends on the fundamental balance. Your ability to share that extra cost with your clients, share that extra cost across the whole supply chain. Fortunately, we do receive comments from the customers in the container shipping industry, the big shippers, and also in other industries, that they are, of course, accepting to some extent that they are to bear the burden. But bear in mind that for several years, they have not really cared about the shipping industry losing money on a daily basis, right? So have that in the back of your mind when you put a 100% passing on costs into your spreadsheet, because it may only be 50%, and will that be your plan B? And what about 25%? Will that be your plan C? How do you prepare for that? On that happy note, thank you for your time. Thank you, Yuri, for giving me the opportunity to go just slightly over time. Hopefully, you found this to be, food for thoughts, going into a bit more physical food. I shall be happy to take any questions or comments during the day. Thank you so much.